I have been trading cycles now myself for over a year in the futures markets. It's not the only thing I do, but a lot of people have been asking me, where have you been? What are you doing? Well, I've really been putting my own technology, my own methods to the test with my own money, because I want to make sure it works. When I develop technology and bring it to other people, I need it to be validated, and it's been working. And cycles have been a very important part of what I've been doing for well over a year now. I would not be doing as well in the markets as I've been doing without intraday cycles. So I believe intraday cycles are present. They work. It's difficult to, well, it's hard work. Just like Lars said, you saw that chart he put together. That was a lot of hard work. It is hard work to trade cycles intraday, but it can be done, and I do think it can be fruitful. And I think we'll also just continue to learn how to use this technology that Dewey developed and that Lars and I have continued to enhance. And whether you're doing intraday cycles or daily or weekly cycles. So we'll continue to dig into the technology. All right, let's talk about cycles. Especially as I'm doing short-term intraday cycles in the markets here. Why do I think that there should be cycles, intraday cycles in the markets? Well, human beings are dominated by cycles, and so is the biosphere. It's like nothing but cycles. The idea that we wouldn't see cycles in the markets seems absurd and preposterous to me. Cycles in markets are mostly driven by the collective behaviors of human beings. That's what markets are. I do think some cycles are connected to external forces. One of the things I've been doing some research on, along with other board members of the foundation, are geomagnetic and solar cycles. And Dewey talking about that in his book, 50 years ago. Research done by leaders at the foundation, Charles Greeley Abbott, the head of the Smithsonian, the secretary of the Smithsonian, and others, Ellsworth Huntington at Yale University, all looking into these relationships about the sun and biological life. It's an obvious relationship. It's kind of ridiculous to think that there wouldn't be something there, right? So more on that to come. All right, we use digital signal processing, statistical validation, and looking at the cycles, visual confirmation. We don't fully understand cycles, and that's okay. Jim Simons just passed away, the GOAT of markets, greatest of all time. He didn't understand what his models were necessarily cause and effect, but he was the GOAT. All right, and we are partly puppets on strings. And it's better to cooperate with the puppeteers. Like, that's why we have to learn about cycles, cooperate with cycles. Dewey talked about it in the beginning of his book. Also, it's kind of unpleasant, this idea that we might not be in control of everything, right? That we might be puppets on a string, so to speak. And that's what's offensive, especially here in the West, to many about cycles, and why they're not really embraced by the media. But that is our opportunity. It's our opportunity, if we can be humble enough to acknowledge that there are forces beyond our control that we are subject to, if we can start to study those forces, and if we can start to integrate an understanding of those forces into our own decision-making, it can be a huge help. So last thing before we get to actually looking at some charts, I went to DALL-E, the OpenAI image generator, and I said, please make me a picture that expresses the idea that man is just a puppet on a string. And it generated this image, which was really amazing, because I spent like half an hour trying to go through, all the different stock photo libraries looking for an image of a puppet on a string. And then I asked DALL-E to generate this one. And in a second, I had this image. And it's quite a remarkable image that unexpectedly expresses some really interesting things to me. Like, I think it's interesting, the idea that you have a puppet on a string here. You have gears and cogs and mechanisms, and then you have winds and something a little cosmic going on there. But it's interesting how he's sitting in the strings, right? He's not like fully subject to the strings. He's looking up. He's cooperating with the cycles. He's balancing himself, with the strings. So I just was very struck by this image. And I think it's a great image of how when we seek to understand cycles and we cooperate with cycles instead of pretending somehow that they don't exist, which is just absurd, we can live a more effective life, make more effective decisions, and do better in the markets. So thank you for listening to my preamble. And now we'll move on. And yeah, thanks, Bliss2B. Yeah, it was a really cool image, isn't it? And I will try to keep track of questions as we go. All right, so let's jump over here. Whoops, giving away the farm here before we even get started. And here I am at our Cycles Analyzer, app.cycles.org here. And I'm using the Analyst Pro version here. So this is our advanced version of our software that allows me to do intraday analysis on anything that I'm interested in. So here are my live streams. These are all the things that I track. So Bitcoin, 20 minutes, 2 hours, 2 minutes, 30 minutes, 4 hours, etc. And here are my futures, E-mini futures, 1 minute, 20 minute, 2 hours. And I'm going to start here at the 2 hour. So I'm doing a scan of the 2 hour bars on the E-mini futures here, E-mini S&P futures. And by default, the Cycle Analyzer uses 850 bars. And we can see that all here. It goes back to about March 19th. And each bar is 2 hours. And there's 23 hours in the futures markets each day, 5 days a week. So there's about 115 hours in the futures markets each week. And right away, we can see some cycles. There's a 117 cycle here and a 349 cycle here. And I think those are pretty close to a 1-3 relationship. We can go to the harmonics here and look. And sure enough, the 349 and the 117 are connected. So right away, we've got some interesting prominent cycles with good distinction on the cycle spectrum. Okay. Identified by the AI as cycle number 1 and cycle number 2. And pretty interesting. And short term, anticipated this. Well, let's, here we are right now. Let's see, there's this 349 seems to have bottomed. And the 117 has bottomed, but the 349 has not, is topping actually. So we have a little bit of tension between these two. And again, the 117 and the 349. So, all right, so good that we found some cycles early on that are interesting. We can turn on the cyclic RSI. This is another thing that I use a lot. It's basically a momentum indicator developed by Lars. And let's just stick with the 117 cycle here for starters. It's the number 1 cycle. 117 is what I just said. There was 115 hours a week in the futures markets. So this is essentially 117. It's very close to 115, but these are 2 hour bars. So this is essentially a 2 week cycle, 1 week from bottom to top. Okay, so here's the 5th of June to the 12th of June, and then the 12th of June to the 19th of June. So interesting, right? Right away, just, a simple run shows a 1 week cycle. It's a 2 week cycle, sorry, but 1 week, going one way and the next week going the other way. So interesting. Not surprising that, we kind of get an idea of what happened in 1 week, and then we go into the next week and we say, well, could we just repeat last week? Probably not. I think I'll lean a little bit in the other direction. Whatever it is that, I don't know where weeks come from, period. But there's a weekly cycle in the futures in the S&P 500. We basically had a good week from the 12th to the 19th, and the 19th to the 25th, where, today we're in about the 26th. It's been not as good, right? Not a significant down move, but certainly not an up move. And now we're starting to lean into the up move here. So meanwhile, I usually look further than just what the initial 850 bars tells me. I like to add more data to my intraday analyses. So I'll oftentimes add another 200 bars to the analysis here. Right now, you can see them that they're out of sample. Okay. And then I just click here to reset range. And what I want to see in particular is that cycle in the spectrum down here persisting. So the 118, the 117 became the 118, fell off a little bit. We see another cycle here emerging a little bit at 201. Can add another 200 bars. Oh, the 117 is now the 121 when we integrate more historical data. Okay. Can add another 200 bars. Reset the range. Again, now it's lengthening a little bit. It's about 124. So this is how cycles work. They're not static. They're dynamic. That's why we do dynamic cycles analysis. They move around a little bit. We can say, what their average is or their nominal, but they do tend to move around and they do tend to wax and wane. And I've got a animation that I've made you that I've never shown this before. So here is, here's the E-mini S&P. Excuse me while I just get a little drink of water. So this is starting out with 850 bars, and this is the spectrum, okay? So if I went back here, this is the spectrum here. We've added more data, but if we looked at the initial 850 bars only, it would be pretty close to where we are right here. So as we add more data to the analysis, I'm going to show you how this spectrum changes. Here's about our 115, our weekly cycle right here. This is probably a 2-week cycle. This is a 3-week cycle, right? And so we can kind of step through time, add more data now back to February 22nd, and we can see that the spectrum changes. So I am looking for the cycles that have persisted over time. Maybe they're not as strong in the latest under 850 bars, but I want to see cycles that persist. And you can see here now I'm going actually back, so not fair to you to not know which key direction I'm going. So let me just keep going, adding more data here. This is back to February 12th, January 31st, January 5th, and we can see this cycle here continuing to persist throughout the historical data. As we go back and add more data, it's getting a little finally it starts to bifurcate a bit. Oh, now it's back. Still a lot going on here around 100 and 110, even though it's a little bifurcated. So I hope that what this illustrates is, one, that we're looking for cycles that are persistent. As we add more data, actually, you can see some of the longer term cycles coming into greater clarity. This 300 period cycle is another one that I see a lot across the equity markets on the 2-hour bars. Okay. Look at that. You know, the more data we add, that 300 period cycle is there. And this is now all the way back to the beginning of 2023. So this is how I approach intraday cycles analysis. And using this approach, this is what I found. Again, I haven't shared this before with the public, but this is my master spreadsheet that I look at what's going on with the 20-minute cycles, the 2-hour cycles, the daily cycles, and the weekly cycles. And I look at it for these assets. This is equities futures here, right? These are bond futures, metals, cryptos, energy, and some currencies. And these are all futures. They trade 23 hours a day. They're liquid. I can get in or out of them 23 hours a day without having to worry about odd market hours. And that's what I've been trading and developing. So these are my cycles indicator columns. Oops, try that again. And one of the things I really like to see is what's happening across the complex. So right now, all of my cycles on the 20-minute, the 2-hour, and the daily are largely negative across all of the equities. In addition to that, and we'll look at some of these cycles, okay? I also look at trend, 20-minute trend, 2-hour trend, daily and weekly trend, because I always want to know when I'm trading against the trend. I ideally want to be trading with the trend. If I have to, sometimes I'll trade against the trend, but right now, all the equity cycles that I care about, particularly the 2-hour, which is my sweet spot that I personally focus on, because that's the time period that works for me. But sometimes I want to jump down to and kind of anticipate what might be coming up in the 2-hour, and ultimately want to get positioned into longer term trades over time. So right now, you know, even though the cycles are nicely bearish, and we'll look at some of these on the equities. Okay, that's what I'm focused on. -1 means bearish. -2 means bearish with a cyclic RSI sell signal. Okay, +2 means bullish with a cyclic RSI buy signal. So it's just, you know, 2, 1, 0, -1, or -2. But I'm trading against the trend. The trends are up in cycles in equities right now. They're still up. Maybe a little wavering of the short-term trend in the Russell, but we have not broken support levels in any meaningful way on the equities. One of the biggest mistakes I see people make with cycles is to look at this and go, oh my goodness, look at how all these cycles have turned red now. I better short the market, back up the truck. No, doesn't work that way. To me, cycles are an arrow in my quiver, okay? I think of them as which way the wind's blowing. Doesn't necessarily mean things have to go down, right? We were just looking at what's been happening with this 117, 120-ish market cycle here in the 2 hours on the E-mini, and we can see that, you know, it stopped the ascent, but hasn't been a big downturn, right? we're fighting these positive trends. So we have to look at trends and cycles. I also look at seasonals, sentiment. This is commitment of traders and daily sentiment index, and a little bit of support and resistance as well. And I'm looking at this throughout the day. I'm looking at the complexes, right? I can see here that bonds have negative cycles and a little bit of negative trends on the shorter term. But look, things are, pretty positive on the weekly cycle. So most of this is a correction still in a larger uptrend. So that's how I approach short-term cycles. I'm focused here on the 2 hours, but I'm also looking at either side, a fractal approach, you could call it, at a lower time frame and a higher time frame. So let's go look at a few of the other cycles here. So we looked at the E-mini, and these are my cycles. This is a lot of work here. Been monitoring them for over a year. They're the cycles that I've found to be persistent and effective and work for the kind of trading and the kind of time frame that I'm doing. So let's look at the NASDAQ. 2 hour cycles. Here we are. This 301 in the NASDAQ here. One thing I forgot to say that's important is in this work that we've been doing over the past year, I have found that cycles work best for me when I anchor on a big recent high or a big recent low. So here you can see in the NASDAQ, I'm anchoring my start point of this analysis back at this October 23 low. I'm using almost 2,000 bars here, 1,957 bars. Okay, it's a lot more than 850. And but I'm also looking at a longer term cycle, this 301. So it's been working well. We got the sell signal right about here, right at the top of the cycle. This light blue stuff here is out of sample. Right, so this was the forecast right here. Went right up into the top. Got a cyclic RSI sell signal right here. And, now we're into this down leg of the cycle. Meanwhile, hasn't gone straight down, didn't fall off a cliff, right? It's come back the last few days. It's flatlined. Guess we're waiting for the Biden-Trump debate tomorrow night or the PCE that comes out on Friday morning. But that's just how cycles work. They're one tool, right? We can update this analysis to incorporate all the latest data here. And that 301 still sticks around as the #1 cycle. The momentum has bounced a bit, but turning back down as of the end of today. The NASDAQ and the S&P 500 are very similar. So if I just open up the same cycle I've been tracking on the S&P 500, similar cycle, 299 right here. And this 388 is also a good one. Got an incredible Bartels at 91. And then oftentimes I'll pull in, this 110, 120 cycle here as well. So definitely cycles topping here in the E-mini as well. The cycles that I've been following, that I've identified as being reliable and persistent. So let me grab all the latest data here. Again, got this 111, 300, 388. If you want to pull that into, maybe a little more lift, but definitely we got some negative momentum here. I think that 386 is the one that's kind of driving that up move. Let's see here. Or maybe it's the 111. Yeah, it's the 111 that's bullish here for another few days. All right, so that's what I'm seeing on the S&P 500. And let's look at the Dow. The cycles are different in the Dow than they are in the S&P 500 or in the NASDAQ. They're similar in the NASDAQ and the S&P. Different in the Dow. We've got, we do have this 123, 231. We go back and anchor on that October 23 low. Pull in all the latest data. See what we got. Again, this 120 here. Got a good sell signal from the cyclic RSI and a down move in the cycle on the number 2 cycle, right? Then we also have this 398 right out here at the tip. Again, maybe a little more lift. Again, this is which way the wind blows, okay? I'm keeping an eye on it all here on my spreadsheet, but I've definitely seen the cycles in equities turning down, going into bearish phases. Have to keep in mind that the trend is still on the side of the bulls. We don't want to pretend that it isn't. We don't want, cycles are counter trend, right? If a trend goes on for a long time, the cycles are going to start saying, hey, we got to change trend here. But no, we don't. Trend can override cycles for whatever reason. Seasonality is also pretty bullish in equities through at least the first couple of weeks of July. Sentiment is bearish from the commercials and bearish from the small trader who's gotten really bullish, basically, and you want to take the opposite side. So that is the general approach of how I'm doing intraday cycles analysis and what I'm seeing in the equity markets. Let me take a quick look over at questions. I see 300 period cycle. Yep. Okay. Nothing jumping out as very pressing. So let me continue on for just a few more minutes. I just wanted to show you a couple of things again about trading. I hope this isn't too much, but I think this is really important. So this is my own Jupyter notebook, it's called, where I manage my portfolio and my positions. I've been developing these ideas here in this notebook and then integrating them over here at RiskSmith, which is a free risk management service. It's still coming along. It doesn't do everything I want it to do, but I've made some good progress. So I just wanted to show you here, these are actually my current positions. Short 3 Russells right now. Short 2 golds right now. Short 1 Bitcoin, long a little Ethereum, short some crude oil, long some yen, and yep, that's how it was earlier today. So here's my portfolio, and my diversification score for this portfolio is 53%, which is good. I like it to be above 50%, and my exposure is $13,500. That's kind of my worst case scenario if everything went against me all day long, kind of my worst possible day. So let's see, is somebody, that's good. Okay. All right. So what I want to show you here is that this is my table here that I call my possible trades table. These are all the other trades I could make, right? Because I showed you these are the things that I trade. So I could go short or long any of these other assets here. And I've sorted this table by correlation to my existing portfolio. I said I trade uncorrelated assets. So the least correlated opportunity to my current portfolio was earlier today was the euro. And if I went long the euro, I could actually increase my diversification by about 6 percentage points, and it would reduce my exposure by $550. So I know this is a little complex. I just want you to know this is possible. And I'm going to be talking about this more in the weeks and months ahead. But let me show you what happened when I took this same portfolio. I didn't sell anything. Okay. I used more capital and I added another position in the euro, long the euro, that was, I learned about from, what's the least correlated next good bet I could make. So let's go down here to portfolio B now, where I added it in, and indeed my diversification by adding in that euro trade went up to 6 points to 58%. And my exposure actually went down by about $500. So I took another $5,000 of risk in the euro, because that's my average risk size per position. But my net exposure of my whole portfolio went down. That is the power of uncorrelated bets. So when we can put together, 3, 4, 5 uncorrelated bets. By the way, why did I like the long euro trade? Well, here it is right down here. Okay. Yes, the trends are against me, but the cycles on the hour, 2 hour, the daily, and the weekly are all up. There were some really nice, you can actually go look at the cycles in the euro. I was down here. So the 2 hour. This was, earlier today with the cycles turning up. We can go look at the 20-minute cycles. Got a nice, strong, prominent cycle here. Adding in the cyclic RSI, got kind of momentum bottoming, coming into a bottom on a very prominent cycle here. Interested in dipping my toes into this one. It's an uncorrelated bet with my existing portfolio, and I get free exposure. Last thing I want to show you for the traders out there, this is just my correlation matrix for all the different things I trade. What I really want to highlight here is this US dollar. The US dollar is negatively correlated to almost everything else except natural gas, which is just, as far as I can tell, a totally random market. But I pay close attention to what's going on with the dollar, because if the dollar is rising like it was today, okay, I want to know that, because that is a headwind against basically all my other possible trades in the markets. So even if I see, a short-term good cycle turning up, but the dollar is making new highs, that's something that I take into consideration with my trading. All right, I'm going to leave it there. I know I covered a lot. Let me stop sharing now and come back to the screen here. Get you guys back on screen number 1. All right. Hello, Ron.
Hey, Richard. Fantastic insights. We covered lots of important ground in terms of, well, intraday cycles is a case in point. The fact that we haven't been able to do that ever.
I know. I go into the archives and I see the meticulous, painful, handwritten notes, that Dewey and others were doing for decades, right? And to think that we can take this same technology now and do intraday, cycles analysis in real time is mind-boggling.
What's your take in terms of some of the key areas that you focused on? So intraday cycles, the importance of risk management,
Yeah.
not lining up with all the signals, whether it be time or versus trend. There are a lot of really important insights that you shared there, but maybe we start right at the top in terms of the psychology of trading the cycles, because I know that's a big part of a focus that we both share.
I mean, I think
traders often have challenges with.
Cycles can be very seductive because you do see sometimes regularly, actually, they make absolutely spot on, mind-boggling, accurate predictions. And you look at that and you say, oh my goodness, I think I've found the Holy Grail. I have found that to be a big problem, right? So we have to be careful with cycles. And especially, I didn't show this, but the daily cycles started to turn over a couple weeks ago on the equities. And one of the things that kept me from shorting was that the 2-hour cycles were quite bullish still, and giving perfect, momentum buy triggers together with a cycle bottom on cycles that I've seen, hang around and be persistent for a long time. So that helped me to not, jump the gun on the daily cycle, especially when the trends were also very positive. We can't pretend that trend doesn't matter, that we have a magic bullet here to tell us when the trend's going to change. No, we have to respect trend. I think we have to use cycles and trend together. I love Jake's sentiment approach of looking for where do you have excessive sentiment leaning in one direction or another to help us find those big trades. I'm really interested in the Japanese yen right now. I think that could be a good, trade to the long side eventually. But right now, it's been a beautiful trade to the short side for longer than anybody ever could have conceived, So we have to be careful with cycles. I try to go out of my way to make it clear to people this isn't a holy grail, that, it can be seductive. Don't have overly optimistic beliefs, but definitely integrate them into your quiver. And nowhere can you do that like you can here at the foundation, especially with this intraday technology.
We have a follow-up question from Dr. Barton about how you define trend in the spreadsheet matrix. Do you find that, and also as a follow-up to that, do you find the NASDAQ moves faster than the S&P 500?
The trends are generally pretty simple. I just want to know basically, which direction things are going. And we back test a lot of different trend indicators. They are proprietary. We find some that work for us, but even if you use just simple like 50-day, 200-day, 50 period or 200 period crosses, etc., don't get overly complicated. Simpler is better. Really, it's about coming up with a system that you can follow, that you can stick to, that gives you a little bit of an edge and that you use risk management with and you get experience with. It's like learning to play the piano. It's like learning to play a musical instrument. You have to practice. You have to get a feel for it. And then you have to use your human intelligence, not just the machine intelligence, not the intelligence of another human, but your own human intelligence to observe, to experience, to get a feel, to develop an intuition, right? That's what great performers do. And trading is a kind of performance. And so that is ultimately the most important thing. And that's why I say, whiners are losers. If you think you're going to come and just get like a signal from somebody else that's going to make you rich, no, it will never work. You've got to do the work. You've got to use the tools. Yeah, learn from people who have gone before you, who are bringing you good insights and information. But ultimately, you got to own it, and you got to practice, and you got to, spend a lot of time at it.
And just to add to that, you had a great point at the end on diversification, just how powerful it is.
I can't believe that people don't know about this. Professionals know about it, but I just showed that briefly because like it was a free trade. It was a free trade. It actually reduced the net volatility of my portfolio by putting on a trade that, it didn't come to my attention right away because, it's not as sexy as the NASDAQ and Bitcoin and crude oil, et cetera. You're like, the euro? Okay. But, it's like showing up there. Hey, here's a free trade for you. Oh, let's go look at it. Oh my goodness. Wow. That's a great setup. I love it when that happens because I'm getting these, it's like a setup that I would have missed, right? If I hadn't had another way of bringing it to my attention, instead of letting all the talking heads, tell me what I should be paying attention to, right? So having a set of assets, a diversified set of assets that you can monitor signals on and trade in and out of, I've found is a really great tool. One for kind of, helping tamp down the volatility, helping my expectations, stay aligned with where I'm at in terms of how much time I can commit to the markets, what's in my bank account, et cetera. So
what's interesting about that is that it was a benefit of risk management as well as new trade setups. And then I noticed right at the end, you highlighted the dollar as being very interesting.
Yeah, the dollar. I always watch the dollar. If you're doing intraday trading, you got to be watching the dollar. And I never hear anybody talk about it really, because it's negatively correlated to everything if you're in the US dollar. So when you see the dollar breaking out to new highs like it did today, watch out for everything else.
We have a few questions in the chat, Richard. I believe the first one from Mike. Why did you settle on 20 minutes and 120 minutes? So why those timeframes? Yeah,
so it's a great question, Mike. The 2-hour time frame is what I really settled on because I was looking at 30-minute charts and then hour charts. But because I can't sit at my desk all day long watching markets, I just couldn't manage those positions. So I had to go to a 2-hour time frame because that basically gave, the cycles that I focus on tend to be 100 periods or longer. And that gave me 1 to 2 week moves. And I use that 2-hour period to manage my expectations about kind of what my worst case scenario would be, right? So that's very important. So zeroing in on what is your time period that works for you, both in terms of how much time you can spend at your desk, and number two, how much volatility you can endure, relative to your account size. Okay. That's why I settled on the 2-hour time frame, not because the cycles were better there. It's because that's what worked for me in terms of the time I had available and the volatility I could endure. How long can I stand, to have things go against me? So, and then the 20-minute is just basically, 2 hours is 120 minutes. So that's about a sixth. I probably could do a 15-minute, but I stumbled onto the 20-minute, and that's kind of my lower level fractal. So I use that to sometimes try to anticipate entries and exits or